Good afternoon, my name is Jordan Lambert, Market Analyst at Gelatoma Management. It is the 8th of July and I'm here with the weekly gold report. For a majority of last week, gold held on to the gains made after its strong bounce from 1179 on the 27th of June, achieving a high of 1267 and trading above 1240 for the most of the week. Italian and Spanish manufacturing data giving early signs Europe may be turning the corner helped gold along with increases in physical demand, and reports gold miners are cutting back on production. Gold became range bound between 1240 and 1260 during the middle part of the week as traders refrained from taking on too much risk ahead of the US Non-Payrolls. Not even Mario Draghi's words at the ECB press conference on Thursday could kick the yellow metal into a new trend, despite the euro-dollar pair falling below 129. However, gold traders somewhat preempted the non-farms number on Friday, causing the market to drift over $15 lower to 1232 before the jobs data was even unveiled. The 195,000 new jobs created sent stocks soaring and forced gold down to 1208, as the better than expected data implied the Fed will probably bring forward the beginning of a slowdown in bond purchases in its September FOMC meeting. The question now is whether gold has fully priced in the impact of the stimulus withdrawal or whether it has further to go along its downward path. According to its historical average ratio to inflation, it has some more to drop, but the fact that miners are reining in supply will provide a good degree of support. Any escalation of fears arising from Egypt's political chaos following the ouster of President Mohamed Morsi could lift oil prices even higher above $100, triggering inflation, which could benefit gold, although the concerns of a supply disruption along the Suez Canal is likely to fade away. Traders that missed the big move on Friday but want some action need to assess whether the decline will continue or whether the market is due a reversal. The 4-hour chart shows how bears could take a low-risk, potentially high-reward trade around 1220 and place the stop just above this morning's high at 1230 to target this year's low at 1179. Bears could even wait for confirmation the decline hasn't finished yet and short if price falls below Friday's 1208 low. Or bears on the patient side could wait for a little rally so price can intersect with the red bearish trend line that I've drawn on the chart, which will enable another low-risk trade. On the flip side, bulls need to assess price action to see whether a reversal is likely. The stochastic and the Bollinger Bands have returned from oversold and signalled buys, but be wary of executing positions solely on the indicators, as they should be supportive, not predominant factors. So bulls should wait for either strongly bullish hammers, higher lows and double bottoms, for example, before taking on the risk. Some fundamental aspects to be mindful of are the ECB President Mario Draghi speaking today at 1:30 GMT before the quarterly hearing of the Committee on Economic and Monetary Affairs, which is likely to be a catalyst for broad-scale market volatility. China's cooling economy is a drag on gold at the moment, as they are the second largest importer of the metal, so traders will be poised for the Chinese inflation data at 2:30 AM GMT on Tuesday, and later we have the UK's manufacturing production at 9:30 AM GMT. Other important events from Wednesday onwards includes China's trade balance, Ben Bernanke's speech, Bank of Japan policy statement and US consumer confidence on Friday. So another busy week for gold. The bearish trend is still intact, however the supply demand factors could force a solid bounce, so trade carefully. Thank you very much for listening to me and I will speak to you again next week.